You are listening to Retirement Lifestyle Advocates Radio. I'm your host, Dennis Tubbergen. Glad you decided to listen in today. Hey, joining me on today's program in just a few minutes is Mr. Martin Armstrong. Marty is the founder of Armstrong Economics. Extremely bright guy. I'm going to get his take on what's going on in the economy. I'm going to get his take on worldwide cash flows as well and what it might mean for you and your retirement. You'll want to stay tuned. That conversation is coming up momentarily. Well, last week, both the Dow Jones Industrial Average and the Standard & Poor's 500 made new all-time highs. That's a big statement, but I really should further define that statement. To be accurate, both stock indexes made new all-time nominal highs. Now, what do I mean by that? When I say the stock indexes made new all-time nominal highs, well, because stocks like groceries and other consumer items that you might buy are priced in US dollars, when the US dollar is devalued or loses purchasing power, any item priced in US dollars sees its price increase. And it doesn't matter if that item is groceries or stocks. As I discuss at length in my in-person educational events, since financial market values and economic data are reported in US dollars, when the US dollar is devalued, the reported values in US dollars are higher in nominal terms. But what about in real terms? To price a grocery item or a stock market index in real terms, the best method to use is to price it in gold. For example, last week, the Dow Jones Industrial Average closed at 46,758. That's the Dow priced in US dollars. Gold priced in US dollars closed the week at about $3,900, and I am rounding. So to price the Dow Jones Industrial Average in gold, one would take the closing value of the Dow in dollars, 46,758, and divide by the price of gold per ounce in dollars, 3,900, and that means the Dow Jones Industrial Average priced in gold is just under 12, 11.99 to be more precise. Now let's go back in time to calendar year 2000. The Dow Jones Industrial Average stood at 10,940, and gold at the time, priced in US dollars, was $283 per ounce. So doing the same math, taking the 10,940 and dividing by the price of gold per ounce, $283, you find that priced in gold, the Dow was about 38 compared to 12 now. So priced in gold, stocks were 3 times higher in 2000 than they are today. So going through that exercise, one finds that in real terms, the Dow is down by 2/3 over the past 25 years, even though it has more than quadrupled on a nominal basis. That huge gaping disparity is due to currency devaluation or price inflation. Now, we can even take this exercise to the extreme. We can go all the way back to 1929 at the market peak just prior to the Great Depression. At that time, the US dollar was gold. $20 gold pieces that contained 1 ounce of gold actually circulated as currency. And at that time, the Dow peaked at 381. So doing the same math, taking 381 and dividing by 20, we find that in 1929, the Dow, priced in gold, was 19 ounces of gold compared to about 12 ounces today. So what we have here is evidence that persistent inflation has been with us as long as the Federal Reserve has been with us. I expect that this trend will continue and will accelerate. And if you haven't yet adjusted your money management strategies and allocations for this trend, the time to do so is now. And speaking of gold and silver, gold's cousin, if you will, they have had huge runs this year in nominal pricing. Now, if you've been a long-time listener to the program or you have been a client of our company, you know that in the beginning of 2025, I suggested to clients that had profits in gold that they take some of those profits and invest in silver, which, in my opinion, at the time, had more upside growth potential than gold. Now, that recommendation has worked out very well. Both gold and silver have had tremendous years nominally. In fact, silver prices now are up more than 50% year to date. And by the way, as a side note, I do not have a crystal ball that works. There are certainly better market analysts than me. However, I possess some common sense. And I made this recommendation based really on the fact that when you look historically at the silver to gold ratio, it's taken about 50 ounces of silver to equal 1 ounce of gold, price wise. At the beginning of this year, that ratio was at an extreme of 110. So, based on silver being extremely undervalued relative to gold, I suggested that if prices revert back to the mean, which they almost always do, not always, but almost always do, silver would likely do pretty well. But now the question to ask is, we have silver approaching $50 an ounce. That was the all-time high in 1980. That was the all-time high in 2011. So we have to ask, is the top in silver near? Well, let me say that I do expect that a price pullback or price consolidation here would not be surprising. Markets rarely go straight up or straight down. However, that said, I believe there is a lot more upside for silver. Why do I say that? Well, Mike Mahari recently wrote a piece on this very topic that I found to be very interesting. Mr. Mahari suggested that when comparing the price of silver to the money supply, you find that the ratio was more than 1,030 in 1980, more than 175 in 2011, and now stands at just 66. So if that's the case, silver has a lot more upside potential here, and I would certainly concur with that analysis. And I believe that long-term silver is going to have a lot more upside. However, let me say that silver purchases at these levels, I believe, should be made strategically. I'm going to be back after these words with my special guest today, Mr. Martin Armstrong. Stay with us. Dennis Tubbergen here, host of the Retirement Lifestyle Advocates radio program. I'd like to invite you to get your complimentary copy of my recently released free report titled 3 Powerful Tax Saving Strategies After the One Big Beautiful Bill Act. To get your free copy of that report, simply visit the website requestyourreport.com and let me know where to mail it, and I'll be very glad to do so. In the report, you may discover how to use a tax-efficient spending plan to get the income you want and give the IRS less. You may discover how to get paid now for future charitable intent, and you may also discover how to get money out of your retirement account at greatly reduced income tax rates. That's all in the free report titled 3 Powerful Tax Saving Strategies After the One Big Beautiful Bill Act. I'll be glad to send you your complimentary copy when you visit the website, requestyourreport.com. The website again is requestyourreport.com. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Joining me once again on today's program is returning guest, Mr. Martin Armstrong. You can learn more about Marty's work at armstrongeconomics.com. That's armstrongeconomics.com. I follow his work regularly, and I would encourage you to do the same. And Marty, welcome back to the program. Thanks for joining us.
Oh, it's always a pleasure.
So, Marty, you're a modest guy, but I'm going to say this because your forecasting over the years has been uncannily accurate. I think it's really unparalleled. Can you share your methodologies with the listeners as to, how you are able to forecast with such accuracy what might lie ahead in the economic markets and in the geopolitical sphere?
Well, as a hedge fund manager, back in the 80s, I saw how capital actually moved. It moves like a herd of wild animals, and it runs from one market to the next. Everybody was like, "Oh, Japan," then Southeast Asia. Oh, it's the Euro's coming, and so you see it all rush around. And as I mentioned before on your show, if you just read Herbert Hoover's memoirs, 1931, and he explains the same thing, and he's not a trader. He's saying that capital acted like a loose cannon on the deck of a ship in the middle of a tempest. It was just rushing from one currency to the next. That's the way it works. So like when Greece got into trouble in 2010, immediately the traders went, oh, gee, who's next? Oh, Spain, So the computer model that I developed, I was one basically, people say I was the first one with artificial intelligence, 40 years ago. But, it was, I understood how capital moved. So the whole thing was to create something that monitored the entire world. And you'd say, okay, fine, it's shifting this way, etc. And then in the mid 80s, we became the largest in the world, mainly because we were doing foreign exchange. And back in the 70s, I just so happened to have had a client who was executive VP of Franklin National Bank. And that was the bank that started MasterCard. It was the first bank that went down in 1974 after the floating exchange rate system began with, Bretton Woods in 71. And he called me in. He says, look, you know about this stuff. He says, I think we have a problem, something to do with currency. Would you come take a look at it? And it was a 10% move basically on the Italian lira, but it was enough to take the bank down because nobody knew about hedging or anything back then. So pretty much after that, any event that took place with currency, I would be called and dragged into. When they were forming G5 in 85, 87 crash, 97 Asian currency crisis. It was called in by China. So I've had a front row seat to all of this stuff. And in the mid 80s, because we were doing all this currency, we were called in by the Central Bank of Lebanon. And they asked if we could create a model in their currency. And I said, sure, no problem. And somebody found a ledger with all the prices written down back into the mid 19th century. We stuck it in a computer, and out came, it said the country was going to fall apart in 8 days. I thought there was something wrong with the data. And I told the client, and very calmly, they said, well, what currency does it recommend? And I said, well, the Swiss franc. And 8 days later, the Civil War began. So obviously they saw it coming. They just came to me for the timing. And then we had a client in Saudi Arabia, was one of the biggest shippers. And he even called and said, Iraq's going to start attacking shipping in the Gulf tomorrow. What do you think gold's going to do? And so you tell me a war's going to start tomorrow? He goes, yeah, yeah. Um, so by 1998, I had stood up in London at our conference there and said, look, Russia's going to collapse. They give it about 30 days. That turned into the long-term capital management crisis, all that stuff. And um, it became clear that the model I created, I didn't intend to forecast wars. But what happens is that somebody always has information. And when they know something's going to take place, they begin to move the capital. Like the Washington Post did an interview with Zelensky. They found out that he knew when Russia was going to cross the border. And they said, well, why didn't you tell warn your people? And he actually told the Washington Post, he says, well, it would have cost me $7 billion if I did.
Wow.
So the accuracy has come from the standpoint that I don't care what market you look at, gold, dollar, whatever. The wild card always comes from the outside because we really are all connected. You can't, this is what politicians don't want to hear. That you can't stand up in the middle of depression, oh, vote for me and I'll eliminate unemployment when the rest of the world is going down. We're all in the same boat. And but politicians want to be able to run to make it think that they can actually do whatever they say, and that's just not true. So the computer's accuracy is because it's looking at absolutely everything. It's just quite interesting that way.
Well, Marty, fascinating explanation. So the next question in my mind is, when you look at world capital flows presently, what are some of the conclusions that you're coming to?
Well, it's clearly showing that war is developing primarily in Europe from a capital flow perspective. And I would point out in 1896, J.P. Morgan had to lend the U.S. government $100 million in gold to bail it out. We were on the verge of bankruptcy. So if you look at it objectively, all right, it had nothing to do with any domestic politician. We ended up as the financial capital of the world because all the capital fled from Europe and came here. So we became the financial capital after World War I. And you can see that today. For example, you can probably go on eBay and buy bonds that were issued by China, different countries, in British pounds before World War I, because London was the financial capital. Today, all these emerging markets issue bonds in dollars because they have to come to New York to sell it. Okay, so New York raises all the money for all these countries or whatever. So that's pretty much it. And when the computer is showing the capital flows are coming this way, and it's linked to these geopolitical things in Europe, it's clear. I mean, when they were forming the euro, because we were the top in currency, they came to me and I sat down with them in 98 and said, okay, fine, this is how we create a currency. And at the time, Helmut Kohl was the Chancellor of Germany, and he knew the Germans would not vote to join the euro. So he took Germany in unilaterally. And he admitted before he died, he said if he allowed the people to vote, he would have lost 7-3. So his condition was no consolidation of the debt. And I warned them that this is a disaster and that, the euro is going to crash. It's going to completely fall apart. And I was told back in '98 that, well, we just have to get the euro in. We'll worry about the debts later. Now we're at a point where you have UK and France uh, teetering on the edge, even hinting that they may need an IMF bailout. Uh, Here's the problem. Because you never consolidated the debt, the European banks have a cornucopia of debt from all these different countries. If I'm a hedge fund manager, I can pick up the phone and say, buy me $10 billion US Treasuries. I can't do that with Europe. I still have to make the same decision. Do I want Germany? Do I want France? Do I want Italy, etc.? Uh, so their banking system is highly at risk because let's say, France, needs an IMF bailout. The traders are going to do what they did to Greece. You're going to say, okay, which banks own the most French debt? And they're going to short those banks. So it turns into a contagion that spreads like a flu or something, and that's what Herbert Hoover was talking about. That capital acted like a loose cannon on the deck of a ship, and this is, I was impressed when he wrote that because that's what a trader would see, and so that's really what our risk isn't so much here in the United States. Our greatest risk is trying to stay out of the war. But in Europe, they promote it. They need it. Because if they don't get war, and you go and they're in trouble already, everything else goes down. Pension funds, things of this nature. So you're going to have people storming the parliaments with pitchforks. It'd be the same thing. Let's say they say, oh, well, we can't pay Social Security. They're going to be storming Washington, D.C. here.
Right.
It's just, human nature.
So, Marty, as you're talking, there's some stories floating around out there. One, you're talking about the fact that capital flows are moving to the United States simply because the capital doesn't want to be in Europe. And then at the same time, we have gold now reaching all-time new record highs and the dollar weakening when you look at the US dollar index. So how do you square those things?
Because basically you have the same sort of thing developing where some more of the retail will buy gold. The major institutions, gold is too small of a market. And, so they'll buy like the blue chip stocks or U.S. real estate. That's why here in the States, they were calling it the everything bubble. Real estate going up, stock market, gold, antique cars, coins, stamps, everything. It's and I've spoken to realtors here in Florida, and he said people even up to $10 million houses are just paying cash because they're just trying to get money off the grid. Basically, what it comes down to. The dollar. I know you have a lot of people saying, "Oh, the de-dollarization." That's really misinformation. What's going on is that when Biden took Russia out of the SWIFT system, that was the most brain dead decision you could ever make, because it sent a red flag to just about everybody else. If you don't do what we tell you to do, we'll take you out. And Blinken even threatened China. That's what created BRICS. They go, oh, okay, so we better figure out and create our own system. It wasn't because the dollar is not backed by gold or all this other nonsense that people say. It's simply geopolitical, and you can't blame them. And then China started selling off U.S. debt and buying gold. Why? Because gold is neutral. If you have these people saying, "Oh, we're going to be in war with China," whatever, um, then they have to be absolute idiots that own our debt. Because you go to war with China, we're not going to pay. They know.
Mhm.
You're going to say, "Oh, okay, fine. You own our debt. Well, here's $1 trillion in interest, so you can buy some more missiles to shoot us." Uh, the logic doesn't hold up. So that's why China started dumping U.S. debt, etc. It had nothing to do with gold or anything else. This was all geopolitical. Um, that's the backdrop to BRICS.
So, Marty, do you see the move to countries lining up to maybe not lining up, but applying to join BRICS? Do you see that trend continuing?
Uh, Only if you really get into war. Um, the reason the U.S. is the reserve currency, there's a few reasons for this. All right. One, the U.S. consumer is a third of the world economy. So you want to sell your BMWs or your Toyotas, you got to sell it in dollars to Americans. All right. BRICS is nowhere close to that yet. All right. Eventually, you're talking a few decades. Okay, they can build up. China is trying to build up a consumer-based economy, and eventually it will surpass the United States, but not right now. And you're then you have Europe, and I would pay attention to this. Europe is trying to push through with their CBDC. And as soon as October, they're saying, but I think maybe more like January. But Europeans routinely cancel their currency. Uh, the Queen died. All right, they canceled the old currency mainly because they're very Marxist. Let's say you got 100,000 in cash stashed in a safety deposit box. Oh, we're canceling it. Here's the new one. They force you to bring it out. Oh, where'd you get this from? Did you pay your taxes? This is the way Europe works. The United States is the only country that has not canceled its currency. All right. I was on flights internationally when the new $100 bill was coming out. And they were running, information, the old 100 bills are still valid. We're not canceling them. They had to say that on all the international flights because everybody else does. And that's why 70% of the paper dollars, are held outside the country. They're held in China, Russia, everywhere. Why? Because it's a hedge against their own government. All right. You can't hold euros because you can't trust them. 500, note euros, they're worthless today. Nobody will take them. The same thing with Switzerland canceled all its currency. And Britain has. I mean, they all do this. Canada canceled all its high denomination currency a couple of years ago. They just cancel it. You got to bring it in. Oh, where'd you get this? And it's all taxes and Marxism. That is really what this is about. So, those are really the backdrops behind the dollar. And all this rhetoric about de-dollarization, I mean, that's very nice. But, you have to look at this thing from a practical standpoint, too. And U.S. has never canceled it. We can't even do the CBDCs because the Fed came out and said they can't. Trump said no, but the reason, it's constitutional. To do a CBDC and to be able to look in your account, they need a search warrant. This is why with COVID, they developed the model. Okay, the First Amendment says the government cannot censor you. So what did they do? Okay, they pick up the phone, tell YouTube. No problem. Facebook, whatever. That's why you see stable coins here issued by different banks because the Fed cannot do it. And talk about war. You can look it up. In 1863, to fund the Civil War, they issued, they allowed the banks to issue their own currency. So you had all these banks issuing national currency, provided 90% of it was backed by bonds from the government. Staple coins is the same thing. They're war bonds. Okay, fine. It's exactly the same model again. You can issue these stable coins, every bank can, if you're backed by US government debt. So it's the same thing. They're war bonds all over again. People think, oh, it's crypto and all. Really? Okay. Very nice. I mean, the whole crypto thing was always decentralized, away from government. I don't think so.
Um, that's a terrific analogy and a great perspective. Marty, I can't believe that whenever I talk to you, the clock is always my enemy, I feel like, because I enjoy our conversations so much. My guest today has been Mr. Martin Armstrong. The website is armstrongeconomics.com. Marty, thank you for being so gracious with your time. Always enjoy our conversations. Love to have you back down the road.
No problem. Take care of yourself.
Thank you. We will return after these words. Dennis Tubbergen here, host of the Retirement Lifestyle Advocates radio program. I'd like to invite you to get your complimentary copy of my recently released free report titled 3 Powerful Tax Saving Strategies After the One Big Beautiful Bill Act. To get your free copy of that report, simply visit the website requestyourreport.com and let me know where to mail it, and I'll be very glad to do so. In the report, you may discover how to use a tax-efficient spending plan to get the income you want and give the IRS less. You may discover how to get paid now for future charitable intent, and you may also discover how to get money out of your retirement account at greatly reduced income tax rates. That's all in the free report titled 3 Powerful Tax Saving Strategies After the One Big Beautiful Bill Act. I'll be glad to send you your complimentary copy when you visit the website, requestyourreport.com. The website again is requestyourreport.com. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. And thanks again to my special guest today, Mr. Martin Armstrong, for joining us on today's program. You know, certainly when you look at the financial markets, caution is probably the number one bit of advice that I would give to anyone aspiring to manage their nest egg effectively. Certainly that's true when you take a look at stock valuations presently. In the opening monologue today, I talked about the fact that stocks are up in nominal terms, but in real terms, priced in gold, they are not up. Now, there is another measure of stock valuations that also provides a pretty clear snapshot of the value of stocks. Now, this indicator, if you're a longtime listener to the program, you heard me talk about in the past, it is the Buffett indicator, named for the famed Omaha investor Warren Buffett, who once stated that this was his favorite stock valuation metric. Now, the Buffett indicator is simple to construct. All you do is take the total capitalization of stocks or total value of stocks and divide by gross domestic product or economic output. Since market capitalization is measured in US dollars, and gross domestic product is measured in US dollars, this indicator effectively removes the devaluation of the US dollar from the measurement. Now, this Buffett indicator has only been over 200% one other time historically. It is there again now. What does that mean? It means that the total value of stocks is now more than twice the output of the U.S. economy. To put that into perspective, the 20-year average is about 125. We are now at about 220. So the Buffett indicator is now at all-time highs. That tells us there could be a lot more downside risk in the current stock market than there is upside growth potential. And I'd encourage you, as I close today's program, to think about and learn about incorporating exit strategies into your portfolio to help you protect your portfolio from a stock market correction or a crash. That's my program for this week. I'll be back again next week. Thanks for listening.